Hello and welcome to today's Five with Fitz. I'm Keith Fitz-Gerald. Thank you for joining me. You know, the markets begin the day split, meaning that the S&P 500 and the NASDAQ are green, while the Dow is red. But they've all now turned to the downside. This is not a surprise given Powell's commentary and the ongoing tariff tantrums. But you know what? It's not a bad thing either. My experience in history suggests that a little tug of war every now and then is exactly what the markets need to shake out the weak money, to shake out the weak hands. Both of those things, of course, pave the way for another run higher eventually. In my view, patience and discipline are the two most undervalued assets in the market today. Just saying. Anyway, here's my playbook. Number one for today, NVIDIA. Buy the dips? That's what the super savvy Richard Dean in Dubai wanted to know when we sat down for his show, The Business Breakfast. Plus, my thoughts on Apple, Google, and Pfizer. You can watch that video elsewhere on my channel. I think it's an interesting time in the market and there's lots of opportunity. Number two, Uncle Powell strikes again. This is unbelievable to me. I mean, we've been over this so many times I've lost count. Powell got transitory wrong, failed to recognize inflation as it blossomed, held rates too high for too long, and now we're supposed to fawn over every last word out of his mouth? I mean, it makes no sense. Once again, Jay Powell and his crew proved to be in firm command of the obvious when he noted during remarks at the Economic Club of Chicago and admitted what many people have been thinking, that the Fed may find itself, quote, in the challenging scenario in which the Fed's dual mandate goals are in tension. I mean, who makes this stuff up? Unbelievable. Markets, of course, tanked almost instantly, and they're still reeling today. Would somebody please take away the mic? Now, the thing about this is that people will inevitably try to make what's happening political. But the last time I checked, incompetence isn't a party thing, so don't fall for it. Money doesn't do politics, but politics sure as heck thinks it does money. Keith's investing tip in this is really simple. Focus on what you can control, like buying great companies, controlling risk, and building your wealth. Why do I say that? Because history is very clear that investors who wade into the fight intelligently come out far wealthier when the storm passes than those who don't. Number three today, dividend investors. Beware if you're counting on insurance companies. United Healthcare Group just slashed its 2025 profit forecast, citing runaway medical costs. Like that's a surprise, but specifically from a surge in Medicare Advantage demand. Now, I don't know about you, but I was born in the middle of the night. It just wasn't last night. I find it very interesting that United Health is being investigated for fraudulent medical billing practices, which, I don't know, could have something to do with the revised forecast, but I digress. That news alone shaved 20.77% off the stock as I type. It'd probably get worse. Translation in my mind, this isn't just a miss, folks. This is a ginormous warning flare. Dividend investors who count on insurance companies for a variety of reasons are particularly at risk. Now, I doubt very seriously that United Healthcare is the only one alone on this with regard to billing practices and rising costs. I think the so-called safe haven health insurance companies are proving to be anything but, which is why I'm talking about it. Meanwhile, I'm still sitting well outside the health insurance space, and in fact thinking about putskis. I bet the stocks will go down. That's a different story, but the risk-reward math just got very interesting, so we may be talking about this one again. Number four today, Palantir just made defense spending an annuity. This is a genius move. The company has teamed up with SpaceX and Anduril to pitch the U.S. Golden Dome missile shield. Now, what we're talking about here is 400 to 1,000 plus satellites to spot missiles, another 200 birds armed to take them out. The business model is really interesting. It's a twist here, something we haven't seen before. It's not ownership, it's a subscription. Uncle Sam rents access, which means the bill never stops coming. Now, what I like about this approach is twofold. It's a new investment opportunity that A, has faster deployment when the nation really needs it, and B, potentially avoids endless cost overruns and the loss of control that typically plagues projects like this. If it flies, and pun absolutely intended, this could shove Lockheed and Northrop into the cheap seats, at least in space anyway. Watch this space. I can't stop with the puns today, sorry about that, but I can't resist. This is just too good to pass up. Literally watch this space. Now, my POV on this one is one I want you to take to heart. A lot of Wall Street missed Palantir, and you can bet they're not keen to see that happen again. The stock seems to be basing just under $100, which means, if I'm correct, that it's building strength for another run higher. And finally, point number 5 today, a perfect example of buy the best, ignore the rest. Costco is doing what great companies almost always do, delivering results, not headlines. Think about it, a 12% dividend hike, 20 consecutive years of dividend increases, special payouts when they matter most. I've made no bones about this. Costco is a prime example of my investment philosophy, summed up in just 6 words. Buy the best, ignore the rest. Think about it. With high margins, record-breaking membership growth, and an accelerating return to scale, Costco isn't just holding steady like the market wants to think. It's building unstoppable momentum, stability, and consistency, all of which results in a smoother ride for savvy investors. I mean, heck knows, I've been beating the drum about this for long enough. I hope you're on board, and if not, that you plan to do something about it. Here's why. Shares have returned 3,085.96% over the past 20 years compared to a still respectable but far less 570.37% from the SPY, a popular S&P 500 ETF, and just 198.14% from Target. So put another way, you can do the math just like I can. A $1,000 investment in Costco 20 years ago would now be worth approximately $31,859.60. That same $1,000 in the SPY would be worth about $6,700, and in Target it would be worth around $2,900. So here's the investing tip on this one. You can invest like everybody else and settle for table scraps, or you can make a change and join the winners. Now, if you're already there, keep doing what you're doing and keep going. If you're not and you'd like to be, I'll be here and I'd love to toss my hat in the ring. In fact, I'd be honored to help you make that journey along with other super smart investors from around the world who are already part of the One Bar Ahead family. Now, today's bottom line, I think, is really appropriate. What I want you to think about: the markets are jittery, AI headlines and clickbait dominate. Many, if not most, investors are chasing shiny objects and forgetting the basics. So what to do? Well, the words of Japanese monk and master gardener Shunmyo Masuno come to mind. When you are uncertain, simplicity is the best way to go. As always, make it a great day. You got this, I promise, and I'll see you tomorrow. Well, actually, I won't. It's Good Friday. The markets are closed, but I will see you Monday.